In this topic, we are going to look at how to determine if you are an applicable large employer. We will be discussing the ACA Applicable Large Employer Report that is provided in Sage 100 as a tool to help you determine if you are an ALE. It is important to remember that the ACA Applicable Large Employer or ALE report is made available to you as a self-help tool for your independent use. Sage cannot and does not guarantee the report's accuracy or applicability to your circumstances. The calculations are currently based on legislation effective January 1st, 2015. Recalculation may be required if such legislation changes. In order to comply with the Affordable Care Act, hours of service must be reported by calendar month. Because hours worked are tracked by pay periods in Sage 100, which may span multiple months, a calculation is performed to arrive at an approximate monthly total. The total is an estimate and may not reflect the actual hours worked. For specific tax or legal advice, see a professional tax service provider or an attorney as appropriate. Also, as we mentioned before, if your system was not set to track perpetual payroll history for the year on which you are reporting, the data in the report may not be complete. So, how do you determine if you are an applicable large employer? Well, the goal is to determine if you have an average of at least 50 or more full-time and/or full-time equivalent, or FTE, employees. Based on hours, you'll calculate the number of employees for each month. That can be easy if you have all full-time employees and not much variation, but for people who have maybe 45 employees this month and 60 employees next month, and some of them are part-time and some of them are full-time, that can be a complex issue, which is why this report is useful. Then to determine your yearly average, you simply add the number of employees you had each month and divide by 12 to calculate your yearly average. Now let's look at how hours are calculated on the ALE report. The report uses the data from the perpetual payroll history files. Full-time employees are those who work 130 more hours per month. Less than 130 hours per month are part-time employees, and these are IRS definitions. Part-time employee hours are used to determine the full-time equivalent, or FTE, employee count. No more than 120 hours per month can be counted for a part-time employee. Again, that's per the IRS regulations. So for employees who work more than 120 hours per month and fewer than 130 hours per month, only 120 hours can be included in the calculation. The formula used to determine monthly FTE count is the total number of hours accumulated by all part-time employees with a cap of 120 hours per employee divided by 120. The result is calculated to the second decimal place and then rounded to the nearest whole number. Let's take a look at an example of part-time employees. In this example, there are 3 part-time employees. Notice that Susan has worked 122 hours this month, but the report will only include 120 hours in the calculation, according to the IRS regulations. So the calculation will be the 275 total hours divided by 120 to equal 2.29. This will be rounded to the nearest whole number for the FTE count, so the FTE count for March will equal 2. So to derive the total employee counts, first your monthly full-time and FTE employees are added together to determine the monthly total. Then to get the average count for the year, the monthly totals are added together and then divided by 12. The result is rounded to the nearest whole number. Use this average count to help you determine whether your company qualifies as an applicable large employer. Now, to add complexity, not everybody pays on a monthly basis. And for ACA reporting purposes, hours must be reported by calendar month. Sage 100 tracks hours by pay period, which makes sense. When a pay period spans more than 1 month, a calculation is performed to prorate the hours and determine how many hours are counted toward the total for each month. For biweekly pay cycles, the calculation will be used if the pay period ends between the 1st through the 13th. For weekly pay cycles, the calculation will be used if the pay period ends between the 1st through the 6th. The formula used to calculate the hours counted for the current month is the day of the period ending date divided by the days in the pay cycle times the hours worked. The remaining hours count toward the previous month's total. So let's look at a bi-weekly example. Jerry is paid for 80 hours and the pay period ends on July 4th. So for the ending date of the pay period, divided by 14, the number of days in the pay cycle, times 80, the number of hours worked, equals 23. So there are 23 hours counted for July. Then to calculate the number of hours for June, 80, the number of hours worked, minus 23, the hours already counted for July, equals 57. So those are the hours counted for June. And you can see that on the report below. And here is a weekly example. Alan is paid for 40 hours, and the pay period ends on July 3rd. 3, the ending date of the pay period, divided by 7, the number of days in the period, times 40, the hours he worked, equals 17. And those are the hours counted for July. To calculate the hours for June, 40, the total number of hours worked, minus 17, the hours already counted for July, equals 23. And that gives you the hours for June. And again, you can see the hours in the report below. When you have pay periods that span multiple months, there can be differences between the perpetual history versus the ALE report. Let's look at an example. On the top is an ALE report. This report was printed for the period from July 1st through July 31st. We see the hours for Jerry and Alan. Jerry shows 23 hours and Alan shows 17. On the bottom is the perpetual history report for the same time period. Jerry shows 80 hours and Alan shows 40, both the actual hours they worked. Because the perpetual history report is pulled based on check date and the ALE report uses the prorated calculation because the pay period spans more than 1 month, the figures between the two reports are different. If the ALE report was printed for July and August, the ALE report might more closely resemble the hours worked in July, but it still might show some variation from the perpetual history report. Just be aware that the purpose of the ALE report is not to show the actual hours, but to give you a year-long estimate of your average employee count. Now let's see how to run the applicable large employer report. Open Payroll, ACA Applicable Large Employer Report. When you are in the task window, click Earnings to Exclude. Specify which, if any, earning codes you want to exclude from the report. Note that only earning codes that use the standard and add amount to rate entry methods are included in the report calculation. Next, enter the date range for the report. The maximum range is 12 months. Because of the need to prorate the hours worked for pay cycles that span multiple months, the report calculations will be more consistent when you generate the report for the maximum 12-month date range. If the report is generated for a shorter date range, the prorated hours for some months may not be reflected in the report totals. To include information on seasonal employees in the report, select the Print Seasonal Employees checkbox. Seasonal employee information is printed in a separate section on the report, and the information is not included in the report totals. If you only want to print total figures, select the Print Totals Only checkbox. Print and review the report. If you need to, change any selections and reprint the report. After closing the preview window or selecting to print, you will receive the message shown here about updating the employee counts. Click Yes if you want to update the ACA employer file. These counts will then appear in the monthly detail window accessed from the ACA employer maintenance. This is discussed in more detail in the topic related to setting up employer ACA information.